Thank you all for joining us today, and welcome to the One Investment webinar entitled Prudent Investors Playbook for Market Instability. This webinar is about to make the most of is trying to help you make the most of municipal investing in these uncertain times. There's been a lot going on in the last couple of months, and the team from PH&N will walk through this. We are joined by three individuals from PH&N Institutional, which is the One Jibs OCIO provider. We have Martin Leclerc, Paul Purcell, and Dylan Ray with us today. They have a great presentation to basically dive into how to leverage Prudent Investor to make a stronger investment portfolio for your municipality. But before I hand over the mic to them to start their presentation, just a bit of a quick recap. Ontario municipalities, all are available or all are allowed to join the PI regime. This is a new investment avenue that became available since 2019. It opens up the world of investing for municipal investors, and it provides a much more robust way to build a diverse portfolio. You have to actually explicitly opt into the Prudent regime, which requires a bylaw, and you have to be part of a municipal service corp. This board fulfills the function. And if you want to learn more about how to set up an investment board or join ours or talk about Prudent Investor generally, please reach out to us and we'll follow up separately. With that, I will hand the mic over to Paul to proceed with the presentation.
Great, thanks, Keith. So this webinar is going to touch on and expand on the themes that we covered in the recent newsletter article. So we're going to cover the market environment. Some years are more interesting than others. This year's turned out to be extremely interesting, and it's only May. And then we're going to get into really getting at how institutional investors deal with a market like this. And one of the key tools is diversification. So we'll look at the fundamentals of diversification, and then ultimately strategic asset allocation and its particular importance during these times. So let's start with the market environment, and it's a bit of a tradition that we start with a cartoon, though I find our cartoons tend to be a little bit more bittersweet than actually funny. This one, I think, summarizes how we're all feeling these days, that the world could be dramatically different every single day we get up. And preparing presentations in this environment is challenging. Our slides are obsolete as soon as we prepare them. And at the very least, we're in a world of incredible uncertainty. And we see that on the next slide with the roller coaster that we see in markets. So this is showing the US stock market, the S&P 500, since the beginning of the year. And the roller coaster that's been on, the sharp fall more recently with Liberation Day, the jump as the 90-day pause was announced, and stock market going up and down with every headline. So extremely uncertain in the short term, but as we'll get into later, not as uncertain in the longer term. And that's something that we'll look at. Okay, so with that backdrop, we'll spend a few slides just on what are tariffs. We'll come back to what had been occupying the market and investors' minds before all of this tariffs, and how have tariffs affected that. We'll get into how markets have been reacting so far this year. So this slide, what is a tariff? And at the end of the day, tariffs are a tax paid by the importer on imported products. So if the US, for example, imposes tariffs, then these are taxes that are going to be paid by the US importers. And perhaps that's the only politically feasible way to raise taxes in the US these days. But it has a profound set of consequences, a profound ripple effect through the economy that imposes the tariffs and all of the exporting economies. A lot of words on this slide, and I won't go through all of them. I'll just kind of scan down the left side here. So there's There's the upfront impact, the uncertainty that I've mentioned that we've certainly seen, front-loading demand, and then the near-term impact, the tariffs themselves, the boycotts, dumping, and then ultimately monetary and fiscal stimulus, and then the long-term impact, which is perhaps the U.S. does more onshoring, but at the same time, kind of a loss of trust that global trade relies on, and this is kind of color coded, so anything in red and orange and yellow is more negative, and ultimately, I think most economists agree that tariffs are net very negative. Whose economy is most exposed to U.S. demand? And as it turns out, we are. You look at the U.S. Exports to the U.S. as a percentage of a country's GDP. You can see that represents almost 20% of Canada's GDP. So we are very dependent on exports to the U.S. in our economy, surpassed only by Mexico and Vietnam. In contrast, despite all the headlines about the U.S. And China trade war, China is much less dependent, with only just over 2% of their GDP representing exports to the U.S. And then within Canada, the situation varies fairly dramatically by province, and Ontario is one of the more affected provinces. Alberta is the most affected, at least in terms of percentage of GDP, but Ontario is right up there as well. This slide is about as up to date as possible on the tariff state of affairs, describing in the top section here the tariffs that are in place, baseline tariffs, the tariffs on China, the very significant tariffs on steel, aluminum, and autos that are impacting Canada and Ontario specifically. The good news in the middle of this slide is that at least the recent direction of travel has been for lower tariffs and more exemptions. But at the end of the day, there are further tariff threats ahead. The 90-day delay, globally will run out in July. We've got possible renegotiation of the USMCA, further tariffs planned. So we still are in a substantial state of uncertainty, and as I noted earlier, even uncertainty itself is very, very harmful. And we're seeing that show up in the economic statistics so far. This chart is showing the growth in jobs in Canada. So we're showing that the number of new jobs created in Canada each month, going back a few years. And it's been mostly positive, and it needs to be mostly positive. Canada needs to be creating new jobs. The population of the country has been growing. And then we see this sharp downturn in March of this year, the most recent statistics. So the growth in job, the pattern of the growth in jobs has turned down to net job losses, which is very unfortunate and a sign of this uncertainty. And we see it, on the next slide here. We see it in some other measures. So on the left-hand side of this chart, we see consumer sentiment, which is a measure of consumers' confidence to be spending money. And when we look at that in both Canada and the U.S., you can see how that's turned sharply down. So uncertainty creates lack of confidence. Lack of confidence itself will create lack of spending, and you get into a little bit of a doom loop. The lack of spending, basically means the uncertainty will cause the economy to turn down. And so then you get, our economist has said that the GDP growth has lowered GDP growth expectations. So for example, to Canada for the year of just 1%, which is very low, and has increased the outlook for inflation, more so in the US than in Canada. But any increase in the inflation outlook, I think, is particularly unfortunate, considering how hard the central banks have worked, raising interest rates, inflicting some degree of sacrifice on people to lower to lower first to raise interest rates to lower inflation. So it's a shame if inflation then does pick back up. And if we see on the next slide, just what I was describing, we had in the post-pandemic area this huge spike in inflation, and the Bank of Canada had to raise interest rates to slow the economy to force inflation back down. And now we are back in the target range of 1 to 3%. So again, it would be very unfortunate to let inflation escape again after all of the higher costs and the sacrifice that people and businesses have had so far. All right, so then let's just look here at the Bank of Canada policy rate on the left side, and we're showing the U.S. policy rate as well. The rate increased dramatically in the period from 22-23, and the Bank of Canada was able to start cutting that rate in 2024. So that the Bank of Canada's overnight rate is 2.75% now, and that's an overnight rate. The chart on the right side here is showing the yield curve, or basically the yield on bonds of all maturities, and give or take, the yield curve is at around 3%. So it's come down from the last couple of years, and that's good news for borrowers, whether they be individuals, businesses, or governments. So that's the setup for the economy, and now Dylan will pick up what that means for markets.
Okay, great. Thanks, Paul. And good morning, everyone. So we're going to switch gears now and just take a look at how the markets are reacting to the situation that Paul's just outlined. We'll start with the asset class that I suspect the majority of you on the call have the most exposure to, and that's bonds. And what this slide is showing are the returns of bonds at the three maturity ranges. So short bonds, those are bonds that have maturities of 2 years or under. Midterm bonds, those are maturities of about 3 years to 10 years, and longer term bonds, the majority of 10 years plus. Now, of the three, your bond exposure will be short or midterm. Longer term bonds are generally only held by pension funds that are trying to offset future liabilities. We're also showing the performance by bond type. So Canadian government bonds, provincial bonds, and bonds issued by private corporations. And what you can clearly see on this slide is that bond returns for both the short and midterm bonds are positive on the year, somewhere in the neighborhood of around 2 to 2.5%, depending on the issuer type. And this is, of course, what we would expect. Bonds are there to add stable income during normal markets and to serve as that protection and ballast in your portfolio to offset weakness in other asset classes, equities in particular, during times of market stress and uncertainty. What the difference in return between the maturities, though, is telling us is that the market believes the near-term impact of the tariffs will likely be slowing growth, and that, of course, would mean lower rates. Longer-term bonds are lagging, and that's really telling us that the market's not sure what the long-term impact of the tariffs will be, particularly on inflation, which Paul just described as coming down, but certainly we would understand that inflation being a tax, or tariffs being a tax would likely have an upward pressure on inflation. But the main takeaway with this slide is just to show that the core part of your portfolio, largely for most of the largest part of your portfolio, is doing its job, is adding value, and is protecting your capital during this period. If we turn to equities on the next slide, we do want to put into context how the current volatility represents quite a big departure from what we've seen in the equity markets over the past 2 years. If you've been invested in equities over this time frame, you'll know that we've just experienced 2 exceptionally strong years in the markets. On the left-hand side of this slide, you can see some of the returns for the key indices over the past 2 years, so 2023 and 2024. And what you can clearly see here is that the returns were very strong over that time period. That's most strongly represented in the U.S. market, which you can see on the left, represented by the S&P 500, which is up a staggering 30% over the past 2 years. Now, to put this into context, we would typically expect the S&P to achieve a return of around somewhere in the neighborhood of 7 to 9 or 10% annually on a good year, any normal expectations. The other major markets, you can see Canada here included, are all positive as well, but far less so than the U.S. And this gap of performance isn't new, isn't something we've seen in more recent years. It's really been the case since the end of the financial crisis in 2010. We've seen the U.S. sort of outperform. The U.S. dollar, which we're not showing on this slide, has also outperformed all other currencies over that time period. Now, if we fast forward to the right-hand side, you can see that the U.S. exceptionalism, both in terms of the currency and in terms of their stock market, has reversed fairly dramatically so far in 2025. And this is somewhat surprising, as typically during periods of market uncertainty and stress, we actually see we typically would see a flight to safety in U.S. assets, but that's clearly not happening here. Now, the U.S. market has historically gone through cycles of relative outperformance and underperformance versus the rest of the world, and we don't believe we're in a situation where this time is different. Our own expectations at PH&N and GAM for U.S. stock returns versus the rest of the world have been declining in recent years as the U.S. has been, outperforming to degrees that are sort of above what we consider normal. We don't yet know, of course, if tariffs are the catalyst that will bring about this rotation away from the U.S. to other markets. But we do think that we're certainly likely towards the end of this current cycle of sort of U.S. exceptionalism, and that there remains really good opportunities for equity investors in markets outside the U.S. As investors and as investors in the equity markets, periods of high uncertainty and volatility are never fun. I mean, we see equities are risk assets. They're priced daily when the markets are open. Obviously, they're priced in the seconds, and we have to watch this volatility, play out in real time. And for many of us, even those of us with lots of gray hair and have been in the markets a long time, this can cause anxiety and a feeling of wanting to react in real time as well. Now, to be clear, we don't have a crystal ball, and we have no way of knowing if this current period of volatility will be short-lived or if it's something that'll be a bit more prolonged. However, we do feel the context is important, and it's important to remember that we've been through similar and arguably much worse periods of uncertainty in the not too distant history. What this slide's doing is just reminding us that these sell-offs and periods of high volatility are first of all, they're just part of the investing experience. And to some extent, the equity market is always facing some wall of worry, if you will, that it must overcome. As long-term institutional investors, which certainly you on the call are, however, it is important to tune out the noise and focus on your long-term objectives, particularly in these periods. Therefore, we would never recommend making any dramatic moves to portfolios based simply off the day-to-day gyrations of the markets. These decisions should always be based on your own long-term objectives. Now, this doesn't mean, of course, that you shouldn't consider if underlying fundamentals are shifting, such that the composition of your portfolio may need to be tweaked to better position where we think the future opportunities in the markets lay. What this table is showing you here is RBC GAM's current valuation scorecard for various equity markets. I do appreciate that's not the easiest slide to understand at first glance, but essentially the diagonal line across zero, as you can see, represents the relative value of each market to its own history. Above the line, we believe that that market is overvalued, and below the line, we believe it's undervalued. And the diamond represents where that market is currently. So if we look at the U.S., represented by the S&P 500 on the left, for example, we would say, in our view, that it is slightly overvalued, while you can see other markets, the Canadian market, and to varying degrees, other ones as well, are all undervalued. Now, to be clear, a market could be over or undervalued for good or bad reasons, and the U.S., for example, has looked overvalued on lots of different measures for quite some time. But that made sense to the extent that the U.S. does have and has had the highest quality companies, particularly their tech giants, that are just unmatched in the rest of the world. There's no comparable for Microsoft or Nvidia or Apple, obviously, in any other market. And what these companies have shown over the recent years is that they've been able to grow their earnings such that they've been able to justify those valuations. So as investors, you've been well placed to be in those markets, and you've been rewarded for buying up for the quality, if you will. However, we do need to consider if the tariffs and the other policy changes that are coming out of Washington are changing the situation going forward. The tariffs are part of a broader policy of deglobalization that certainly started under Trump's regime, but was continued to some extent under Biden as well, with specific restrictions, for example, on tech to China and other protectionist measures. This, in theory, should be positive for the U.S., given that they'll onshore more manufacturing, and that'll benefit their domestic companies. The problem from an equity market standpoint in the U.S., however, is that the companies that will benefit the most from this environment are not the largest companies that are represented on their stock market. The companies that are largest on the U.S. stock market are the ones that have been the biggest beneficiaries, arguably, of globalization. So that's the tech giants in particular, Apple, Amazon, Nvidia, Microsoft. These are the companies that are the most at risk. And I think this is what you're seeing with respect to the US market now underperforming and a lot of the sell off we're seeing there. In contrast, the world stock markets, the rest of the world is generally less exposed to globalization. And they're entering this period of volatility and higher uncertainty with valuations that are very cheap relative to both the US and, as you can see here, their own history. So we do feel there are good opportunities in equities, and particularly outside the US, for investors to potentially take advantage of right now. We've talked a little bit about the rotation at a country level, and obviously we think that there's good opportunities and better opportunities outside the U.S. But we do think that this is a similar case, perhaps at the underlying stock level. What you can see here is that the index, and we're looking at the U.S. index again, the S&P 500, is constantly changing the leadership, so the top weights in it. We're showing the top weights in the S&P in 1980, in 2000, and the end of last year. And the key takeaway here is that market leadership is not permanent, even though certainly in the moment it can feel like it'll be permanent for a long time. And the other takeaway is that the indices are backward looking. They are dominated by the past and present winners, but they're not necessarily positioned for the future winners. If you had loaded up your portfolio in 2000 with those stocks you can see here, GE, Cisco, Intel, Exxon, and held it to today, you will have greatly underperformed the broader markets. In our view, this current level of concentration, and you can see actually the other point, I guess, is that just how concentrated the markets have been in the top 10. This represents a risk. And this is why, as active managers, we tend to emphasize greater diversification and look to position the portfolios where we see the best opportunities for the future and not try to chase the index, as it's not at all a good predictor of where the future leaders will be. So with that, I'll pass it back to Paul to dive into risk and reward.
Great, thanks, Dylan. So we've talked about the uncertain times, and we've talked about what that's meant for markets so far. Let's talk about now how investors, institutional investors, approach these markets, and we'll start that by talking about the principles of risk and diversification. And then in the next section, we'll talk about the importance of strategic asset allocation. All right, so on the next slide, it's important for investors to realize that they're in the risk business. So investing is about risk management, not risk avoidance. And I really like this analogy that risk premiums are like atoms and asset classes are like molecules. And I actually like this analogy more than we have time to really dive deep in it. But it just illustrates that investors get paid for taking different types of risk. And you can see that on the top half of the slide: equity risk, credit risk, illiquidity risk. These are the risks that investors take in order to earn a premium. And then asset classes like stocks and bonds and real estate and so on are really like combining these different risk premiums. So for example, the molecule of bonds combines credit risk and duration risk and inflation risk. And that you get these different combinations is really what makes diversifying across asset classes meaningful and worthwhile. When we look at diversification, we're looking at reducing risk. So let's just pause and say, what is risk? And I like this picture. For most people, this represents their idea of risk, something very bad happening. This is the literal train wreck scenario. And so for most people, risk means something bad, and investing, it means sharply negative returns, something that we want to avoid. Now, it's a little bit easier in building a portfolio to use quantitative measures. We're just illustrating here a common, not perfect, but a common way to think about risk and return when building portfolios. So assuming we have an asset, looking here to the top left, we have an asset that has an expected return of 4% and a volatility of 6%. And what that means is represented by this chart here. The expected return of 4% is in the middle of our distribution. And that volatility of 6% is, in statistical terms, one standard deviation. So 2/3 of the time, this asset will have a return somewhere between -2% and +10%. And in that smaller probability of times, it'll have an even higher return than 10% or a lower return than -2%. So with that, let's now think about building a portfolio and looking at diversification. So let's introduce another asset. So we have asset 1 that I showed on the previous page, and now we have asset 2 that has a much higher return of 8%, but also a much higher volatility. So could have much higher returns and much more negative returns. And now we think, well, we actually need a return that's higher than 4%, but we don't want all the risk associated with asset 2. So we want a portfolio that is some combination of asset 1 and asset 2. And if these two assets were perfectly correlated, so they went up together, they went down together, then the portfolios you could build would be along this line. If you wanted a portfolio with a return of 6%, you could put half of your investment in asset 1 and half of your investment in asset 2, and you would get a portfolio plotted halfway along this line. But that's not really showing much benefit of diversification because these assets move in lockstep like I described. What if these assets were perfectly negatively correlated, like a seesaw? If we combined two assets that were perfectly negatively correlated, we'd get a line like on the next slide. And so combining combinations of asset 1 and asset 2 would give this pretty awesome line, actually, because now you could get a return of, say, if you wanted a return of 6%, you could get a return of 6% with actually much less risk than if you even invested in asset 1, which has a return of 4%. So perfectly negatively correlated assets are like magic, but unfortunately, like magic, they don't really exist in the real world. You just don't see perfectly negatively correlated assets. In the real world, we get assets that are somewhat correlated with each other, and we demonstrate that on the following slide. Here we're showing an asset assets that are modestly correlated. But even modestly correlated shows the benefit of diversification, because now you can get by picking a portfolio along this line, you do see some benefit of diversification. Anytime this line kind of goes to the northwest, you're getting higher returns for less risk. So that bend in the line is positive for investors. And now with that, how can we do better than this? We can do better than this if we add more assets. So let's add a third possible asset to our chart here. So asset 3 here, in and of itself, doesn't have particularly attractive risk and return characteristics compared to the line, the portfolio you could build with asset 1 and asset 2. But when we add asset 3, it gives us, we can build the portfolios along the gold line here. The gold line represents combinations of assets 1, 2, and 3, and demonstrates that as we add assets, the line pushes to the northwest, again, higher returns for less risk. And that's really the essence of diversification. And these assets aren't perfectly negatively correlated. That would be ideal. They are positively correlated, but as long as they're not perfectly positively correlated, they give us that benefit from diversification. So let's make this a little bit more real world. When we think about Ontario legal list investing, it's highly constrained in terms of what an investor is allowed to access. And so we've shown this similar type of line, assuming that we can invest in Canadian bonds and Canadian equities. But then under prudent investing, where we have access to global markets, and just by our little donuts here, you can see much more colorful with access to global stocks and bonds. We can push that line out so that we can get, in this case, a higher return for the exact same amount of risk. And this is the essence of diversification, and at the same time, the case for prudent investing. And to make it even more real world, this is, without a lot of detail, but a snapshot of some of the portfolio modeling work that we've been doing with one investment, where we are looking at these optimal sets of portfolios across a scenario where we just have fixed income investing, and then if we add equities, we can push the line up and out, and then if we add alternatives, and these represent different possible optimal portfolios depending on investors' return objectives and risk tolerance. And that sets us up well for now getting into strategic asset allocation. And I'll turn it over to Martin.
All right, thanks, Paul. So let's put this all in practice, and I'll do this over the next, 7-8 minutes. Okay. And full disclosure, it's going to be fairly high level and simple, but it's nonetheless important. So let's start with, what is a strategic asset allocation? Well, it is a long-term investment strategy where investors would set target allocation for different asset classes, right? Just like we just discussed, like stock, bonds, cash, and then we rebalance periodically to maintain those targets. So it is based on the principle of diversification to manage risk and achieve long-term investment goals. So this is what the theory that Paul just discussed. Now we just saw this chart. So let me isolate two distinct strategic asset allocation, A and F. A is a long-term allocation that only include fixed income markets. And F is an allocation sitting on the efficient frontier that includes fixed income, equities, and alternative investments. Risk and reward profiles for both portfolios are quite different. So the big question is, which one is the best for us? And how do we go about selecting which allocation is the most appropriate for us? And so to do that, we need to follow a process. But just before discussing this process with you, let's just take a step back, right? So on the left here on this slide, on the left, we have what we call the MNRI, the money not required immediately, or the reserves. And on the right, we have a future project we committed to. Right? It's often an infrastructure project, it could be a road, a recreational center, etc. The project has a cost or a future value and a timing, right? Will the project be initiated in 5 years or 20 years, right? This is where you see the time horizons here. The purpose of investment management is to create a path for the current reserves to fund the future project. Therefore, which portfolio, which of A or F will allow the municipality to fund the future project it committed to? Which of A or F will give us the greatest probability of success? And so to answer that question, the answer to that question does depend on how well we understand the nature of our investment challenge. Now, there are two possible outcomes when it comes to investing our reserves for the purpose of funding a project. The first outcome is the MNRI fails to achieve a certain funding threshold, and those are the undesirable outcomes. And the second outcome is the MNRI has grown to fund all or a significant portion of the project. And that's the green area. This is the investment objective. And that's the path we want to be on. But it's only possible if we consider the following, if you will, risk factors. I'm just going to go over three that are extremely important. Let's talk about the mismatch between the size of reserves and the cost of the future project. Now, the bigger the mismatch, the more risk we should be willing to take to generate more investment returns. Another risk, important, you know it, the inflation rate that we are exposed to, right? And the need to protect the municipality's purchasing power over a long period of time. A third risk is the investment horizon. A lot can happen over time, as you know, like cash flow risk, planning risk, opportunity risk, and so on. So is the project meant to start in 5 years, which is a fairly quick time horizon, or 20 years? Well, all of this does influence our ability to take risk. And failing to consider those relevant risk factors will lead to adopt likely a suboptimal allocation and increases the odd of an undesirable outcome. So where do we go from here? Well, we do follow a process, and that's a process that we implement or execute with every investors we work with. So the first step is, who are we as investor? Right? This is the question that you have to ask yourself. Who are we? What are we investing for? How do we define investment success? And this is the step number one here, where we identify but also quantify the investment objectives, the risk tolerance, the investment horizon, the liquidity needs, and any other special circumstances impacting the municipality. That information should be captured in the municipal investment policy statement. The second step here is where we identify the asset classes that are appropriate or most appropriate given the assessment in step one. Are we going to invest in only domestic fixed income, or are we going to expand to include global fixed income and credit? Are we going to go into equities? And are we going to go into global markets as well, and alternative investment? Those are all questions that need to be asked. So this is where the prudent investor regime is vastly superior to the legalist regime by allowing an unlimited access to capital markets. So it gives you more tools, more risk management solutions, and obviously more opportunities. The third step, well, this is the science step, if you will. This is where the investment professional will use modeling tools to create an optimized portfolio using the permitted asset classes, a little bit like what Paul presented when he talked about the efficient frontiers. So the optimization process will create a well-diversified portfolio that can either minimize the amount of risk necessary to achieve, our long-term return objectives, or maximize the return per unit of risk we are willing to take. The outcome of step 3 is our strategic asset allocation, or a portfolio that sits on the efficient frontier. And the last step, step 4, this is the execution of the investment strategy. This is the monitoring, the reporting, and obviously this is keeping a line of communication open between all parties involved in the execution of the investment strategy. Why? Well, simply because, first of all, capital markets evolve. As we discussed earlier today, over time, markets move, they change, and we need to be able to adapt the strategic asset allocation when required. But also, and perhaps more importantly, the circumstances of a municipality is not static and can change. So this 4-step process should be really revisited periodically. It's just part of good governance, and it's prudent to do so. Now let's bring back our both portfolio here, portfolio A and F. So in step 1, as you will recall, the investors define their objectives, right? And so investors with different objectives will need different investment portfolios. Portfolio A here could be suitable for a municipality wanting to preserve its purchasing power over a 5-year period, which is fairly short. for a project that is well defined and perhaps already partially funded, right? In that case, here the investor has a risk appetite that's somewhat low. Portfolio F here could be advisable for a municipality with no immediate project associated with the MNRI and wanted to maximize its return potential over the next 20 years. The modeling exercise that we do after will then determine the underlying diversification and strategic asset allocation. So those two are existing portfolios that we have developed for one investment in the one JIB. Couple of observations that I think is important. Equities are not a necessary component of a prudent investor portfolio, as we demonstrate here. The other observation is the asset class weights that we see here, or the strategic asset allocation. This is not set in stone. They will be reviewed and adapted periodically to make sure that they do remain optimal. So then again, once again, two different portfolios for two very different investment goals. Now to recap, municipalities were all impacted by the global economy and capital markets, and that impacts, municipalities' ability to fulfill their financial obligations and aspirations. Therefore, we need to be able to adapt to economic and market conditions. That's the essence of prudent investing. A well-diversified, strategic asset allocation will chart a path between our reserves, current reserves, and our long-term financial obligations in the most effective way. So thank you for your time. That's the presentation for today. So I'll turn over to you, Keith. Thank you all.
Thank you, Marty and team. There was one note from Jennifer Hess about MNRI, which is a terminology we throw out. It's kind of embedded. We know what it means, but sometimes it gets lost on the audience. That is a short form for money not required immediately. Under Prudent Investor, the money not required immediately, this long-term money gets invested by a joint investment board, and the rest of the money stays with the treasurer to be invested for operating purposes. We did have some questions from Terry about she missed Dylan's comment about who in the U.S. market is likely to benefit from, we'll just say, the noise that's going on in the markets presently.
The beneficiaries of the U.S. market as a result of the onshoring are likely to be domestic U.S. companies that are focused on domestic U.S. consumption. So you can think of regional banks, you can think of companies that are focused more on the U.S. consumer, and that was in contrast to the companies that have been the beneficiary of globalization and freer trade, which are the tech companies that, again, make up the biggest component of the U.S. market. So the beneficiaries in the U.S. of result of more onshoring will be U.S. manufacturing, but that's a very small component, of course, right now of their stock market, which is where the risk lies, I think, in the U.S. market as a whole.
Well, that leads me to one of my own questions. The market has been noisy, as we all note. There have been some winners and losers. I thought maybe it might be an opportunity. This is not at the strategic level, but just at some of the other winners and losers. The ones that I think are more prominent. Gold was up, I don't know, $500-700 since the beginning of the year. And there's this other esoteric investment factor that I know is involved in some of our allocations, low volatility. Maybe I'll just invite someone from the PH&N side to comment on these themes.
Thanks, Keith. Well, I'll give a few comments on gold, and maybe I'll turn to you, Dylan, to make a few comments on low volatility equities. So yeah, gold has had quite a run. Gold is a challenging investment to model. It is not an income producing asset. So when we think about building portfolios, we want to have some sense of expected return and expected risk. And gold doesn't lend well to that. So you don't see portfolios typically hold gold directly. But where you will get exposure to that increase in gold is in equity portfolios where you'll have gold miners, and if the fund managers are positive on these companies and hold the gold managers in the equity portfolios, then those stocks would participate very well in the run up in gold prices.
And with respect to low volatility equities, so low volatility equities are a style or an approach, if you will, of building an equity portfolio that looks to own companies that are, as the name would suggest, less volatile than the broader market. Again, it's a diversified approach, so it's not just consumer staple companies. Our low volatility portfolios have tech companies, but the kind of tech companies they would own are the ones that are more utility like, so less exposed in terms of economic issues or economic growth, more focused on, as you can imagine, on a company like Microsoft that effectively is a utility, if you will, as opposed to maybe a company like Apple that is a bit more exposed on the consumer side. As you would expect this year, that's been a very good year for low volatility equities. Given that we see a lot of volatility in the market, the kind of companies that are less volatile are outperforming the companies that are more volatile. So we are strong proponents of having a low volatility sleeve in your portfolio. We think it serves well and alongside broader equity exposure, and it's doing quite well and benefiting those investors that own it certainly this year to date.
Thank you very much, Paul and Dylan. We have a few more questions from the audience. Well, one relates to municipal debt. Obviously, those calling, and some of them actually issue debt, and it's not uncommon for municipalities to own the municipal debt of other municipalities. Yeah, the question is really about liquidity and who is this the type of thing that would one way or the other get into the portfolios that are invested by the joint investment board or through the OCI provider?
So when in this talk, we talked about diversification, and we diversify across asset classes, but we also diversify, within asset classes. So in the strategic asset allocation Martin showed, there were allocations to Canadian bonds. And so when in the portfolios, when we have a portfolio of Canadian bonds, we will have a portfolio a fund that will own hundreds of bonds, not just tens of bonds. It will own hundreds of bonds. It'll own Government of Canada bonds. It'll own provincial bonds. It'll own corporate bonds, and it will hold municipal bonds. Municipal bonds are a fairly small part of the Canadian bond market. But they are represented, and they are represented in the funds. The portfolios themselves wouldn't hold single lines. It wouldn't hold just a single line of municipality XYZ, but there will be municipal bonds as part of the broader bond portfolios.
Thanks, Paul. Another question, I think this may be yours again, Paul, is talking about the fancy modeling you had in your presentation, the long-term returns and correlations, volatilities, and that. How are these influenced? How are they built? Are they entirely based on backward-looking information? Are they likely to return? Maybe you can just talk broadly about how forward-looking these things are and how they're used.
Yeah, great question. So even in my simple example of asset one and asset two, we had an expected return and an expected risk, and this is a key input into building portfolios. And so if it's a key input, then those expected returns and expected risks they need to be current and relevant and credible. And so we have a team that creates and updates these assumptions on a quarterly basis. And the expected returns are very much forward-looking. It's not that useful to look at the past when looking at expected returns. You want to take into account current valuations, the economy, the outlook for companies and for asset classes, and that's why it's important to be forward-looking. It's important for us to update these frequently because, as we know this year, the world can change significantly. That's expected returns. Expected risk, it is mostly not so much backwards looking, but informed by history. We know from history that stocks are more volatile than bonds, and we reflect that in the inputs, in the assumptions that we have. Once we have these assumptions across all the asset classes and the correlations, like I showed on those slides, then we have what we need to start building models and matching up portfolios to objectives like Martin described.
Thank you, Paul. The last question of the day, to what degree does nationalism or themes that we're seeing on that front factor into how we should be making investment decisions?
That is a tough question to answer, to be honest. But we've seen for quite some time now that the world is no longer just there's more than one pole. It used to be the U.S., and now there's a second pole that has been moving east, right, around the rise of China. And so with this two-pole world, I think the question that needs to be answered immediately is, okay, we need to diversify, right? The importance of making sure that we capture opportunities and mitigate risk that arise around the world is very important. And so to me, it's a question of, you used to have one pole and it was very polarized and centralized around the U.S. economy. Now you have to account for an Asian economy that's waking up, and that's creating many opportunities for investors. You can only think as the rise of emerging market investment, for example, right? So I see that more as an opportunity to diversify more broadly a portfolio, and that's a conversation that we should have with investors if it's suitable or not.
I want to thank the team from PH&N to share their wisdom and give us this presentation. And if you need to reach out to us for any follow-up, any questions, or any input on Prudent Investor or your thoughts along that, our team is available to help. Again, thank you for joining us today.